Hey, Zoom crew, somebody give me a thumbs up on the audio and video. Are we good? Hey, there we go. Thank you, sir. All right. Now I just need to share my screen and we'll be off and running here in a few minutes. Okay, I'm finally up and running. We got audio, we got video. Let's talk about Module 9 tonight. Let's talk about the test or the homework or the research project or anything else you all want to talk about. And then I'll talk about Module 9, and I have a little surprise for you tonight. I think it's going to make your life a lot easier. So good news there. Um, Any questions? You can go up there. Good. Yeah, yeah, let me try to do that. And if there's any other questions, just hit me. I'll see if I can navigate over to FactSet and we can review that. So the question for anybody on Zoom was, can we review FactSet one more time and how we generate those reports? Okay, FactSet launch. Sorry about that. Something went wrong, it says. Well, let's see if we have the little app. We do not have the app. Okay. Let's see if we can get in there from Microsoft Edge. Sometimes the browser makes a difference. Squeaking over here, it's gonna drive me nuts.
Putting the wall.
Oh, let me get back to verification code. Hmm. Okay, we're in. Okay, so give me your company's name. Uh, so you're working on Archer Daniels Midland. Um, Great book called Rats in the Grain, all about ADM and how they cornered the market on lysine back in the late 80s or early 90s. They made a movie out of it. I think the lead character was Brad Pitt, but I'm not sure. Look it up. It'd be good. It'd be good background. Yeah, so lysine is a protein that you get when you grind up. I think it's the wheat kernel. I'm not sure on that one, but it was a good book, good movie. It's been so long since I reviewed it that I couldn't really even give you the main plot line anymore. But if you're doing all this work on IDM, go check out the movie. Okay, so we just logged into FactSet, and the question was, can you give me a little refresher on where to go to get the research report? And I believe I went into my apps, and I think it was Book Builder that I found that research report. And then there's maybe it was Public Information Book, Create Book Now, and we wanted ADM. And you have cover page, dividers, pretty much we want it all, create book. Okay, and then that's gonna take a few seconds. So we'll come back and look at that, see how we did. Yeah, you have to go in and search the app library and toggle it on or off. And then when you do that, you'll see it. Oh, maybe it's done already. I'm getting a notification. Oh, okay. Okay. So I uploaded two new files to Canvas today. So I want everybody to, if you have your computer open, I want everybody to go in and click on Files. And then I want you to sort by last modified. And is that it? Should be two that I uploaded today. Yes. Two files I uploaded at 3:36 this afternoon. The first is an example of a research report. So this is a research report that I created using AI. I'm trying to get a little bit better at AI, and I'm trying to understand what it means for this class, and I'm trying to understand what it means for our profession. And from what I gather, this class is not necessary anymore. That's the that's the wrong way to say it, but that's quite literally the conversation John Clark and I were having because I went out to Claude and I'm trying to teach myself how to use Claude, and Claude has a financial services module, and I'm going to share all this with you, but the end result is this research report. And I sent it to Dr. Clark and I said, "Hey, John, look at this. I was able to program Claude to recreate the closest thing that I can recreate for the research report we're doing in our class." And he's like, "Wow, that's impressive." So the only thing I haven't been able to figure out how to do yet is the formatting. Like everybody in working on this research report has to have your report in a certain format. But if you set that aside for a moment, you say, okay, well, we don't have the formatting right yet. How is the content? This content's pretty darn good. I had it adhere to our 4Ms approach, and I uploaded all of the PowerPoints that we use in this class. And I told Claude, hey, Claude, here's an example of a research report that we were trying to recreate. I want it formatted like this. I want the content structured in adherence with the 4Ms. I want a cover page, an executive summary, and an appendix. And I want the appendix in accordance with the 10 modules that accompany the book that I'm teaching from. And here's the PowerPoints associated with those 10 modules. And I got it all set up, and I'm going to give you this prompt. I got it all set up where when you use this prompt language, and it's probably ended up being 8 or 10 pages worth of prompt language. All you have to do is type in your ticker, ADM, hit enter, and it's going to take 10 or 15 minutes. But you're going to get a report just like this. I ran this one for Brookfield Corporation because it's a report that we own for our clients. You'll be able to run it for ADM and get this.
Can you go to your Canvas and publish files? See files.
Oh, okay, yeah. Let's thank you. Okay, let me X out of that. And I'll go over here to share to commons, maybe?
Sounds right.
Oh, it's a publish.
Oh, okay. Share resource.
Oh.
Let's give that to everybody.
Are you,
Oh, maybe that's,
are you agnostic to model or do you have to use Claude?
no, I'm just, you can use whatever you want. That's just how I did it. Okay, let's go back in. Let's go to, so module. Then I have research project over here. I want to add it to the research project. Okay, add file. And then I'm going to add that one. And then I'm going to add okay, I think it was UMP. There it is, prompt for Claude. Okay, so now under research project, well, I just hit add button. How come they're not showing up?
Yeah, I see it.
You do see it? Oh, okay, great. So let me see if I can see it. Oh, there it is. Okay. So if you go to the very bottom, you can click back on that Brookfield research report. You can pull that up and you can see that the output is a Word file and you get the ticker symbol, where it trades. So Claude, in this instance, has rated it a buy with a price target of 58. That's 45% upside to the current price at 39. Then you get all of the market data, valuation data, ROE, valuation metrics, 5-year average, peer group average, ROE decomposition, other metrics. We've gone over all of this in class. Then you get the investment highlights here on page 2 in accordance with the 4Ms framework. So management, Claude is rating that an A, and I would wholeheartedly agree. One of the key drivers of this thesis is that Bruce Flatt has been at the helm of that firm for a long time, over 20 years. He just retired, but that succession was well telegraphed. Moat, they own infrastructure, so hydroelectric power plants, those have a really good moat. Mispricing, evidently Claude thinks it's mispriced. The mark, renewable energy, gets a pretty good mark, and then some catalysts, risks, challenges, conclusions, company profile, investment thesis. So word of warning on this, when I shared it with Dr. Clark, he pulled up FactSet and said, hey, not all of the numbers match, but there's a FactSet integration. This is how smart AI is getting. Costs $80,000 a year, but with $80,000 a year, you can buy a Claude Enterprise subscription and a FactSet subscription, and those two will integrate. That's why I say, after talking with Dr. Clark, I don't think this class is necessary anymore because all of the companies out there that do this for a living, 80,000 is just a line item budget for them. You know, if you're working for a mutual fund company or a bank or in corporate finance, you're going to have these tools. So when you graduate from this with degree track and you get out in the real world, kind of going to need to know how to use these tools. So we're looking at FactSet, we're looking at Claude. In the future, you're going to be able to, at the press of a button, have world-class research. So what does the job of a financial analyst become? Now you're kind of an auditor. You're auditing Claude's work. You need to understand the work and you need to be able to audit the work. So here's something else I've learned about LLMs, the large language models that drive Claude. There's a period of time that they have testable data. And you all know more about this than I do. I'm not trained in AI, so let's make this collaborative. My understanding is that there's a period of time where they have testable data that they use the world's internet, for example, to teach themselves how to think. And they can kind of audit that based on real world data. After a certain date, I don't remember what that date is called, but after a certain date when their testable period ends, beyond that, the model hypothetically should have trained itself to draw inferences from future data. So if they see some of these shenanigans that we've been identifying all semester long, playing this little game of follow the penny, Claude should be smart enough from its training data to identify some of those things currently and draw them into the investment thesis. Does it work perfectly? I ran another one of these reports for Boeing. And Boeing just signed one of the largest contracts that they've ever signed with United Airlines. And that was just last month. And Claude didn't catch that the significance of that contract and the thesis that it wrote for Boeing. So now your job as a financial analyst becomes knowing the limitations of Claude. It's just a tool. So what took us a whole semester to come up with before now takes us 10 minutes. And we can dive right into the nearly finished product and say, okay, I know that there's some shortcomings with how we use this tool. Got to read the report, make ourselves familiar with the latest 10K filing and the latest news, make sure everything's integrated with the report, audit the assumptions that the model uses and a discounted cash flow analysis, and then print a finalized version of this. And I don't even know, like I'm rethinking how we do this whole assignment now, because I want you to have an awareness of these tools. I want you to be able to use these tools, and then I want you to be able to audit these tools. And then the grade that, or the assessment has to be something like, okay, I used the tool, I know how to use it. I read the report, here's the shortcomings, and here's my like 1-page executive summary of where the report is spot on and wrong. And here's my updated version of that and the differences. It's almost like we're redlining Claude's work at this point. So,
And I've noticed that it doesn't get like up to date, not Claude, but I use ChatGPT. Like I've like it will say the IRS code is $15 million exemption, and I'm like, I know it's 20 million, go find it. And so then it will like update it, like you're right, but it's like newer things, it doesn't know. So I mean clearly, but like, you know, even when the IRS code was like 6 months old, it still hadn't captured some of that nuance.
so it's a little dangerous in that regard. You really have to be careful what you're using it for. But I was just so impressed with the format that we got back. It's even grading each of the major sections. And at the end of this report, it's giving you a works cited page, which I thought was just absolutely terrific. Breaks down module by module. And then when you go to the end of the report, it's, ended up being 29 pages and you have your works cited right there. So I'm going to encourage everybody in class to use this prompt and then take all this information and finalize it by cutting and pasting what's relevant into the templates that I've provided and I still want to see for the final version of your report. So let me show you. In some way, shape, or form, just kind of tell me. Yeah, just kind of, it doesn't have to be pretty. Just, tell me what you used, what you didn't use, some version of the works cited. Your works cited page will have, okay, well, I used Claude and here's that report it generated. Okay, now let me go back. So I want to show you how to use this prompt. So I gave you an example of the output, and then I gave you a Word file here with the prompt. So all you need to know is that you're going to copy and paste everything in this file. So you're just going to copy and paste the whole thing. And I instructed Claude to act like a chartered financial analyst that had been working for Goldman Sachs, Morgan Stanley, Merrill Lynch for 30 years and was an expert on all things accounting and investment related. So the whole thing looks like we got 10, 12, 15 pages of just prompt language. So you copy all that, and then you go to Claude. Let's see, AI. These are the AI programs I use. I use Gemini, Claude, Grok, Notebook LM, HeyGen, and Perplexity. What else do I need to be using? Anybody you guys got some favorites? All right, well, share it with me if you do. I feel like this is a project we all need to be working on. Okay, so here's Claude. I need to log into my account too. Now, Claude has some usage limits, and I'm not really sure how they track that. They track that in tokens, but I don't know what a token is. And I was in a hurry to get this done. So I bought a pro subscription for $20 a month. I think it'll still work with the freebie. You just might have to wait a couple of days to use enough tokens. Okay. So what you're gonna do here is you're gonna create something. I called it the UMKC analyst. You can call it whatever you want. But in order to make this happen, you're gonna have to go click on projects, and then you're gonna label this project. So UMKC analyst example. So as of today's date, March 31st, 2026. Okay, no projects match. Okay, so that's new project. You got to click on new project. So we'll name the new project. We'll just call it example. I'll call it temporary because I'm not going to keep it. Then create project. Then we go click on instructions and we paste in our entire prompt. Copy, paste, save. And you should be done. So now we have a temp project. So I'm going to go over here to the UMKC analyst project, and I'm just going to, so now that once you have your project all set up, UMKC analyst, now I'm going to go over here and I'm going to type in ADM, Archer Daniels Midland, and I'm going to hit enter. And it's doing its thing. So we're going to give that, I don't know how much, it'll take 10 minutes or so. And then we'll have a 30-page report on ADM with everything that Claude could possibly find on the internet about ADM, all assimilated into this research report in the format that we're looking. and you're gonna get to look at it organized module by module by module. So every week when I show up and I say, I want you to take a deep dive into lease accounting. I want you to take a deep dive into pension accounting. I want you to take a deep dive into ratios and ROE, and you can break down the leverage. That's going to be done by Claude. Now, it doesn't mean that it captured it all. So we still need to go to some other sources like FactSet and cross-reference all the data and make sure that it's right. But man, does it give us a head start. So I now have sufficient data to compile a comprehensive vector report. Let me build the doc. Want to be notified when Claude responds. So sure. We'll just click notify. So I'm just going to let that run. And while that runs, I'm going to toggle over and lecture a little bit on module 9, unless anybody has any questions about how I did that. So you have the prompt language. It was just pretty quick and easy to set up a new project under Claude where I'm recording this lecture. So you'll be able to go back to YouTube and watch me do it. The file is out there, the sample file is out there. Give it a try. Give it a try. And one request that I have is if you make any improvements on it, let me know. I would love to incorporate it into the prompt language just for my own use. I found it pretty useful for some of the stuff.
Something you just said, maybe telling it to pull from FactSet. I don't know if you already had that in your prompt.
I kind of did. What I did is, well,
It won't be able to find you through all the.
Yeah, fair enough.
yeah, so when Dr. Clark gave me that feedback, I took the whole email and I pasted it. I should have shown you the back and forth. I can't do it now. It's lots of thinking. But in order to get this prompt, Claude works with people who are dumb. And I feel like I fall into that category because I saw this idea on Instagram and I made a mental note to try to capture the prompt language that this guy was using. But that mental note failed me. So I go back to Claude and I said, hey Claude, I saw this really cool thing on Instagram where this guy had built a prompt that would spit out a world-class research report with just a click of a button. All he had to do was type in a ticker. Can you recreate that prompt for me? So Claude did exactly that. I'm like, terrific, that's exactly what I wanted. Now, is there any way that you could modify the prompt so that it looked like this output? And I took the Qualcomm report from our class and pasted it into Claude. Did what it did, added some language to the prompt. And I looked at it, and then I looked at the output of the prompt and I said, this is really great. Is there any way you could add an appendix based on these 10 modules from the book that I teach from the class? And I pasted in all the PowerPoints from our class and Claude did it. Like, this is great. Is there any way I could modify the prompt language so that we got a downloadable Word or PDF? Claude did it. Like I said, the only thing I couldn't figure out how to do was to make it look like format we already had. And that might be another AI program. Like one of the.
Or it might be mine, sure, or something on the top, you know.
Yeah.
You can start a little document in your Claude and part of it can just include the actual visual or how you want it to be.
Try it. If you can get it to work, let me know. Let me know. So yeah, it's scary how smart this AI is becoming.
You could put it to that design it or like that, that's a little more popular.
Yeah.
The colors are full of those pants, they like the fun.
So I didn't finish my story. When Dr. Clark shared that feedback with me, I just copied his email, pasted it into Claude, and said, hey Claude, I got this feedback from a colleague of mine. Is there anything that we can do to strengthen the data integrity? And Claude said, sure, here's another piece of code. Paste it into your prompt. I didn't even read the code. I just put it in there. So let's hope that wasn't a virus of some kind. Okay, I'm going to switch gears to something that's not nearly as much fun, but let's talk about intra-corporate investments. And before I do that, I want to turn off the animations. Okay. All right, I'm gonna try to keep this one as lively as I can. It's just not one of my favorite lectures. This is there's a few opportunities where you might be able, there's a few opportunities in here where you might be able to find some shenanigans, so we kind of have to pay attention to what's going on with this accounting. And then there's one other slide in here that talks about spinoffs, and that really is a pretty lucrative place to invest in the markets. But other than that, I feel like this lecture is pretty bland, so I'm going to move quickly. But don't let me moving quickly stop you from asking questions if there's anything about this that's a little bit ambiguous. I won't have time to cover it all. It's a 70-page PowerPoint deck, so I'm going to try to hit the highlights. Remember, there's supplemental materials that come with our book. This lecture is recorded, so if you are coming back to this in a week or 2 weeks and feel like you need a little bit of refresher, look there first and then give me a shout. Okay, so intra-corporate equity investments are, I don't want to overcomplicate this. A term like intra-corporate equity investment sounds more complicated than it is. This is just one company buying stock of another company. One company buying the debt of another company. It doesn't have to be publicly traded. So if one company's private, then you own part of it. Not necessarily stock, but you still own part of that company. And you got to figure out how you report them. So that company's gonna have earnings, that company's gonna have dividends. How do you put that on your balance? There's several different ways of doing that. We know which form of accounting we use based on how much we own. If we just own a little bit, like we were just talking about ADM, if ADM had a stake in one of their competitors, Bunge is one of their competitors, Brazil. If they bought some of Bunge, then they just own the stock, and you just report on it like you would a piece of real estate. Or ADM owns corporate headquarters, we have an address associated with it, for $10 million. ADM owns $10 million worth of Bunge stock, it would sit right on the balance sheet pretty easily. When Bunge issues a dividend, ADM is going to report it as income. Now, if ADM owns a little bit more, if they own like 20% or 50%, we're going to account for it a little bit differently. And we're going to use a methodology called the equity method of accounting. And I want you to think about that as if you were an owner. The equity method is meant to imply that you own the equity and you're going to account for it as if you owned the business. So if you own the business, and you do, but if you own the business outright, if you own 100% of Bunge, then when they reported earnings, well, all of their earnings would flow through to your income. Okay. I'm gonna pause there. I got some visuals that will help illustrate that point here in just a minute. Our authors give us 5 or 6 different reasons why you do this. Most of it comes down to the Porter's 5 forces, how you're positioning your business in the industry to compete against other businesses. Maybe you're expanding your market share or solidifying your supply chain. Those, for the most part, are commonsensical. This is that graphic that illustrates the level of control. If we don't have control, so first level of control, no control, we have 2 methods of accounting. The first one, which was little or no influence, that's the fair value method I just described. Then we have the equity method. And then lastly, if we have control, so if we own 51% of the business or more, we're going to consolidate it. And we've touched on that several times this semester, that consolidated accounting, if we don't own 100%, is going to result in this little minority stake that we call, minority interest. We call it minority interest. And that shows up on the balance sheet, and it also shows up on the income statement because those minority shareholders are entitled to their percentage or their fair share of the income. So where this gets murky is in the classification of influence. 20 to 50% is a pretty wide range. If we have different forms of accounting for little influence, and significant influence, who determines whether it's significant or not? Well, that's what we've been hitting on all stuff. Anytime you see that word estimate in accounting, we know that there's an opportunity for manipulation, we know there's an opportunity for shenanigans. Same way here, if it's up to the determination of the management team whether or not we have significant influence, then it's also up to the determination of the management team where and how we account for those earnings. Then we need more earnings. So our compensation is linked to earnings per share. And we need more earnings. Then it behooves us as the management team to classify those holdings as significant. So maybe it's as simple as increasing our 19% ownership stake to 20. Or maybe it's, as you'll see on the next slide, significant influence can mean a variety of things. If we have a board seat, that's significant influence. If we have contractual arrangements with regard to some of their patent interests or trademarks or shipping routes or supply lines, all of those can be argued to create significant influence in the aggregate. So again, anytime we have some measure of variability, we have an opportunity to influence the accounting. This is almost the whole lecture right here, if you wanted to boil it down to one slide here on page 7. Star this so you can come back to it on the exam if you have multiple choice questions that are asking you about the accounting differences of the fair value method versus the equity method versus consolidation. You'll see the balance sheet effects, income statement effects, and the effects on the statement of cash flow. What you want to recognize is that on the income statement, if we're using the fair value method, dividends are income. On the income statement, if we're using the equity method, dividends reduce the investment account. Capital gains and losses are included in income. Down here, the investor reports income equal to the percent owned of the investee income. So if we're using the equity method and Bunge reports $10 per share in income, that's great. We're going to report $10 per share in income. But if instead they report $10 per share in income and they send $2 of that out the door in dividend, well, the dividend is going to be kind of an expense because it reduces the value of the investment on the balance sheet. And then the earnings are going to increase the value of the investment on the balance sheet. I'm going to show you an example of this, so I don't expect you to have it all straight in your head just yet. But what I want you to know is that they work in two different fashions, two different directions. So start that so we can come back to it and we'll jump into an example here. Keep in mind that these investments we're talking about can come from marketable securities or non-marketable securities, aka private. Okay, on the private example, you're going to see 3 different distinctions. Level 1, level 2, and level 3. Level 1 securities have quotes on Yahoo Finance or Bloomberg or any other quote system that you find on the internet. Those are level 1 securities. Level 2, those are government bonds. Probably got to go to Bloomberg to find a quote on those. And then level 3 are private securities. Where would you find a valuation for a level 3 security? Maybe, yeah. So, okay, anybody familiar with ESOP? Maybe every work for a company that was organized under an ESOP or stock ownership plan. So it's just like it sounds. It's a business that's owned by the employees and they all have shares. If you're organized underneath that structure, then you're required on an annual basis to pay for a valuation, usually from an accounting firm or another valuation firm. They come in and They do what we do. That's a use case for this class. Okay, I feel much less anxiety about the future of financial statement analysis because that is a use case for exactly what we're doing. What I was hoping somebody would answer, and thank you, when I asked the question, where do you get the valuation report for a level 3 security? This is where you get it. You have to hire somebody that's been trained to do what we're doing in this class. And usually that somebody works for a bank or an accounting firm or a valuation firm or something, but they're using this skill set. And they have programmed Claude to do all their work for them, but they're still using this skill set. Okay, let's talk about debt securities. Just like we can hold an interest in the stock or equity of another company, we can also buy their debt. So ADM could buy the outstanding bonds from either another one. So when we hold debt securities, we have 3 different classifications. We have debt securities that are classified as held to maturity, debt securities that are classified as available for sale, and trading securities. So just like with equity, when we have 3 different classifications, we have 3 different forms of accounting, and that creates opportunity for management to say, well, last quarter this was a held maturity security, but this quarter we think we might sell it. So we're going to reclassify it, which means we're reclassifying the accounting. That's going to flow through all the way down the income statement. Let's talk a little bit about each of these classifications. Held to maturity debt securities, just like what they sound like, man, this is where management says, because our plan is to hold this security until it comes due, we can ignore the day-to-day fluctuations associated with that bond. We talked about the movements in bonds in module 5. They generally fluctuate with interest rates. When interest rates go up, price of the bond goes down, and vice versa. With a held to maturity security, we can ignore all of it. Great. Delightful. We don't even have to worry about that. We buy the bond for $1,000 face value. Day one, just sits on our balance sheet for $1,000, and we never adjust the price. For available for sale debt securities, that doesn't apply. For available for sale, we are thinking we might sell these at some point. So when the price fluctuates, we have to keep track of them. Now, FASB allows for us to report the movement in those bonds in a junk drawer. What's the junk drawer? Not net income, but other comprehensive income. So when we get to the end of the quarter, if we have a gain or loss on on available for sale securities, that gain or loss is going to be posted other comprehensive income. And then lastly, we have trading securities. Our authors didn't even give us a slide on trading securities because they're mark to market every quarter, and it flows right through net income. So all of the gains and losses on trading securities every quarter show up as gain or loss on the income statement. And you can kind of think of the recording of those gains and losses by category. Trading shows up on the face of the income statement. Available for sale shows up in the junk drawer, other comprehensive income, and then held to maturity securities just doesn't show up. What now? Question for you. If you're looking at a company and you see that they have large holdings classified as held to maturity, and interest rates have gone up significantly, well, then you know there's a big loss hiding in there somewhere. If the company was forced to liquidate those securities for any reason, just because they want to hold them to maturity doesn't mean that they're going to do. How would you quantify that loss? If they're not reporting it, and they're not required to report it, but you know it's there because interest rates are spiking, how would you quantify that?
So they have to report the interest rates for their. I think you can calculate it on what they're reporting.
Yeah, you're on the right track. So what they do have to disclose is when they issue the bond. when they bought the bond, what the fair price was when they bought it. So you know what they paid for it. Now all you have to do is go look up on Bloomberg where the bond's trading today. And the difference between what they paid for it and where it's trading today is the hidden loss that's on that balance sheet. It's an off balance sheet loss. They lost money. If they had to sell it today, that's a loser. So they have a very large position and held to maturity securities. That's how you would begin to quantify that loss. And most of the time, there wouldn't be anything that would raise a red flag, but you might see it. You might see it. Has anybody on the off, has anybody been paying attention to what's going on in the world of private credit? Okay, great. Got at least one head nod. You may know more about it than what I know.
I just kind of been passively following it. It seems like this the opaque nature of private credit is, there have been a few kind of high profile bankruptcies, and there's significant concern that there's potentially more out there. I think Jimmy Diamond referred to, you know, some of the, bankruptcies that are already happening as cockroaches, and when we see one, there's usually more umbrellas, so there's just kind of that concern out in the market right now. It's obviously all sorts of other hands over the operation.
So that's about my understanding too. It first hit my radar screen when a company called Blue Owl, who issues private credit, failed to meet redemption calls from their investors. And then a second private credit fund and a third private credit fund, and I think even a fourth private credit fund has now failed to meet redemption call from their investors. So what's that mean? Well, that means somebody says, I want my money back. And the private credit manager says, I can't give you your money back because I have these loans out in the marketplace and I can't sell them right now. Like, but if they went to liquidate them, they would have to sell them at such a cheap price, they're likely to go broke. They would likely take the whole fund. So they're not giving people their money back. And it's the first sign that usually this is one of the first signs that something seriously wrong with the market. And you can think of private credit as just another iteration of high risk, high yield, junk type loans. It used to be that you go to the bank and you'd borrow 8, 9, and 10% interest rates, and there was a market for this in kind of middle market banking. But several pieces of legislation have passed over the last 20 years that have tightened up the capital requirements for banks, and that squeezed out these financing opportunities for middle market companies. And private equity stepped in, and private credit stepped in, which was another funding thing. So now these companies can go to private credit companies and they can borrow money. Usually has a pretty steep interest rate associated with it. And the private credit companies, they're not regulated by banking regs. So they can just pool money from individuals directly and issue it to these private credit funds in a market that didn't used to exist. So there's an argument that they fulfill a need in the market, but there's also another argument that, you know, hey, this is unregulated and buyer beware. And it looks like, at least in a couple cases, buyer beware is the right prescription. Okay, where am I? 21. 1, and past that to equity investments with significance. So I laid out the classification for equity investments, and then I laid out the classification for bond investments. And now we're going back to equity investments, and I want to look at an example of the accounting for companies with 20 to 50% ownership of common stock. So let's look at how all of that comes together underneath the equity method of accounting. So I want to go through this example slowly so that we all have a good example of how this works. Assume Google acquires 30% interest in Middle Networks for $300. Middle's balance sheet reports $1,000 worth of equity. Google purchases a 30% stake for $300, giving it the ability to exert quote unquote significant influence over Middle. Okay, so Middle reports profits of 100 and pays a $20 dividend to shareholders, so that would be 6%. This is how the accounting would work. So the first transaction, Google purchases a 30% investment in Middle. Let's first identify the cash. So we have a $300 credit cash. That's cash going on the Google. And we're simultaneously going to book a $300 asset that we're going to label investment or Middle, it could be bug stock. Pretty simple, that first transaction. So now let's fast forward to transaction number 2. Middle reports $100 in income. Google's share is 30. And remember, we're Google in this example. So we're going to increase debit our investment in Middle for $30. So if you owned the car wash, just made $30. So now you put $30 in the bank, and the value of that whole investment just went up. We're recording as if that were right there. So now we have an investment in Middle. It started at 300. We just added 30. So the value of that investment in Middle goes to 330. And then that shows up as equity income on the income statement. That's transaction line item number 2. Transaction number 3, Middle pays a $20 cash dividend. 6 of that goes to Google. So we get the cash. Google gets that cash dividend. That's an easy one. That's going to be a $6 debt to cash. The one that's a little counterintuitive is that now we have to decrease our investment in Middle by $6. So the net effect of that is between transaction number 2 and transaction number 3 is that we booked $30 in earnings and wrote the investment up, and then we received $6 in dividends and wrote the investment down. So net, there's $24 in cash that's still on Middle's balance. Oh, then there's only 3 transactions. So that's a simple example of how a dividend and earnings work against each other to either increase or decrease the value of the target company. So that's a good example. Star that one. I don't expect that a test question or a homework question would get much more complicated than that one right there. Okay, learning objective 9.3, examine, consolidation, analyze consolidated reports. Okay, so I'm just going to go straight to the example. Oh, here we go. Okay. So in this scenario, we're consolidating 100% of the company. So we were just looking at Nissan in the middle. In this example, we're assuming Penman Company acquires 100% of the common stock of Nissan. Purchase price is $3,000. During the next year, Nissan earned $400, bringing the retained earnings to $1,400. On its balance sheet, Penman accounts for Nissan using that amount. Okay, so when we consolidate a company, we're going to add all of the assets together from Nissan and Penman. We're going to add all of the liabilities together from Nissan and Penman. And we're going to present the balance sheet as if they were one company. And we do that by lining them up side by side. So you'll see we have Penman here. This is their balance sheet. We have assets, liabilities, and equity. Right beside Nissan's balance sheet, assets, liabilities, and equity. And if we start with current assets at the top, well, that's pretty simple. We have $6,000 in current assets for Penman. We have $1,400 in current assets for Nissan. The consolidated accounting shows $7,400 in current assets. Easy. you'll notice that the third line there shows an investment in Nissum. Well, obviously Penman has an investment in Nissum, they paid 3,400. They actually paid 3,000 in the first year, yes, and 400,000 for the apartments, and we used the equity method to account for that. Nissum doesn't have an investment in Nissum, so that's a goose egg. Now, when we consolidate, we need to X that out. So that's a canceling entry. The consolidated company is not gonna have an investment in Nissum. The consolidated company is a snapshot of what these two entities look like together. So in that instance, we have to cancel the investment. Everything else gets added together until we get down to the contributed capital phase. And you can see that there's been 2,000 plus 1,400 is 3,400 in contributed capital that shows up on the equity section of the balance sheet for Nissum. So all the equity for Nissum gets X'd out. We're gonna reverse those entries because that equity has already been posted to Penman's balance sheet using the equity method. So when we consolidate, basically we can just get rid of all of the equity that's already on Nissum's balance sheet. Everything else gets added together until we get down to equity income from investments. We had posted 400 from Nissum Penman. We're gonna delete that 400 because we don't want to double count it. And then we have the complete snapshot of the consolidated entity there on slide 34. Remember, this was a 100% ownership. What happens if we only own 80%? Well, if we only own 80%, it gets a little bit more complicated because now all of a sudden we're going to see that line item that we've mentioned several times this semester, the non-controlling interest. This is the 20% stake owned by some outside third party. So we have to put that on the balance sheet here. 20% is just that, 20% of the 3,400. Same story down here, 20% of the 400 is 80. So we have a non-controlling interest for net income and a non-controlling interest on the balance sheet. That can be any percentage. You see that across the board. Okay. And in the last few slides in module 9, the authors just threw a whole bunch of unrelated topics at us. One of those unrelated topics is goodwill. What happens when Nissum buys Penman, or another way around, Penman buys Nissum, and the purchase price is greater than book value? So when the purchase price is book value, we can just take all their assets, put them on our balance sheet. They're worth what they're worth, because however Nissum had them marked on their balance sheet, that's an accurate estimate. That's exactly what we do until the purchase price exceeds book value. And then we have to associate it with something. So we're going to go back down that balance sheet. We're going to say, okay, well, some of these might have been undervalued. So we're going to adjust the value. Maybe we have a piece of real estate on the balance sheet that was booked 10 or 20 years ago and it's appreciated with the markup. Maybe we had some customer lists or trademarks or patents or something else that wasn't accurately reflecting. After we've gone through that whole exercise, if we still have value that we can't discreetly identify, we're going to book a category called goodwill. And I was trying to remember the name of the company I was looking at this week. They had booked goodwill in 3 or 4 different acquisitions over the past several years. They've been on an acquisition spree and they've been writing big checks to acquire companies. And last month they had to take a big write-down. And they said these goodwill assets that we had booked, they're not worth what we paid, what we thought they were going to be worth. Now, translate that for me. When you see a management team take a write-down of goodwill, What's that mean?
And I would think that they overpaid for the company.
Exactly what it means. That's an oh crap moment. Wait. I really didn't want to have to make this announcement, but you remember those dogs we bought a few years back? We way overpaid for that. We got these numbers on our balance sheet that are make believe. They're never gonna pan out. We gotta take the loss. When you see that, that needs to be your indication that this management team isn't very good at mergers and acquisitions. They have failed in the past. What gives me any confidence in the analysts that they will be able to succeed in the future in an area where they have failed miserably in the past? Maybe it was different management. Okay, maybe they had some CEO turnover. That's very common. When you get a new CEO come in, they'll look at the portfolio of holdings and they'll identify one that's not performing up to stuff, and they'll take a goodwill impairment, and they'll blame the old CEO. And that can be a good technique for job owning the price of the stock down a few points. And if your goal is to job own the price of the stock down a few points before your options strike, then by all means use that trick. Okay, so we talked a little bit about impairment. I want to talk about the consolidation of foreign subsidiaries. Touched on this a little bit in the past, but this is one of those categories that is included in other comprehensive income. We talked about what it means to bring income from overseas back to reporting statements that are reported in US dollars. So if we take Apple or Amazon or any multinational globally diversified company, they book revenues in euros, yen, yuan, dollars, and renminbi, and you name it. I got all sorts of revenues. Well, at the end of the year, that has to be presented to shareholders if they trade on the US stock. It has to be presented to shareholders in dollars. They have to translate all the terms. Well, if the US dollar has been appreciated, then those earnings will get translated back at a lower number, and it'll result in a loss. We also have to translate the balance sheet. The balance sheet is really the bigger number because we have all these assets diversified overseas. We might have manufacturing facilities all over the world. We have to translate those assets and those liabilities back in US dollars. So if the dollar's been appreciated or depreciated, you're going to have a foreign currency translation gain or a foreign currency translation loss. And those gains and losses show up in other comprehensive income. And the cumulative effect of that will show up in accumulated other comprehensive income. So what you need to know is the terminology, translation gains or losses. You need to know that it happens every year. You need to know that the gains and losses show up in other comprehensive income. And then you need to have the conceptual wherewithal to understand how a strengthening dollar or a weakening dollar would affect those gains and losses. Those are the likely test questions that you'd get there. Okay, and then the last concept in this lecture is hedged accounting. Let's see. Yeah, describe and interpret derivative disclosures. So this is another area where you'll see hedges flow through to other comprehensive income. There's two types of hedges. We have we have a fair value hedge and a cash flow hedge. This is a good slide. I went back one. Here's hedging examples. Southwest Airlines is the one that I like to use because they have one of the most expensive books of jet fuel hedges that you'll see. So if you're Southwest Airlines, well, you know how much traffic you're going to have. You already have these flights booked, and you know how much jet fuel you're going to need to complete all these flights. you can go out into the market and buy that day at your futures contract. That's a hedge, that futures contract has value and you can trade it. So if the price of jet fuel goes way up like it did, oil's up $58 a barrel on the market. So the jet fuel is up massively. You have the proper hedges on, the value of that hedge book just skyrockets. When oil goes from, well, it's up $58 a barrel and it's trading at 118 today, so that's 60 something. So it's not quite double, but let's just call it a double. When oil doubles, the value of those hedges double. Now that's an asset that sits on your balance. So that's why we differentiate between a fair value hedge and a speculative hedge. If it's a fair value hedge, then we're going to record. I'm going to tell you wrong. Okay. Fair value hedges hedge against an asset or a liability. And the example our authors give us are like Verizon hedges against fixed rate debt. Fixed rate. I gave you the example of Southwest Airlines. That hedges against an expense, which is cash flow hedge. Okay. The difference primarily is that the unrealized gains and losses with a cash flow hedge flow through to accumulated other comprehensive income. So I knew one of them ended up in accumulated other comprehensive income. I just wanted to make sure I didn't tell you the wrong one, because I really only hit on this concept about once a semester. It's very brief. And you can kind of see the wisdom that Fastby's using there. If it's a cash flow hedge and you bought the jet fuel, or you'll need the jet fuel, and then you have the hedge to offset the price movements in that, well, those two things are going to net out, and they're going to net out in very short order. So it would make sense that we don't collude or confuse the income statement by putting those gains and losses on the front page of the profit and loss statement. Okay, and that's really. Oh, no, I lied to you. There's one more section, and then there's one last topic I want to touch on, and then I'll let you go. Equity carve-outs. So IPOs and divestitures, spin-offs and split-offs. You're all familiar with an IPO, an initial public offering. That's how a company goes public. You may or may not be familiar with a spin-off. Anybody ever come across the spin-off? So I own, let's see, last year, J&J spun off a company called Kenvue. So Johnson & Johnson is a global medical device, pharmaceutical conglomerate. And they wanted to streamline their business a little bit, or at least the story that they told. They wanted to streamline their business a little bit and focus on their highest growth, most profitable units, so medical devices. And in order to do that, they were going to jettison some of their other lines that were sleeker, one of which was like their consumer products division. So they Tylenol. So they spun off Tylenol into this other company called Kenvue. So the way that works is if you own Johnson & Johnson, log into your Fidelity or Schwab account today, you see Johnson & Johnson, 100 shares. Then you log in tomorrow, you see Johnson & Johnson, 100 shares. Kenvue, 100 shares. It's the same thing. You own the same thing. Yesterday, you owned a business that included all these units and it was packaged in one ticker called Johnson & Johnson. Today, you own the same exact assets, only own two tickers. One of them's Johnson & Johnson, and one of them's Kenvue. That's called a spin. And You know, management had their reasons for doing something like that. It can be an incredibly profitable and lucrative place to fish for investment opportunities, and I'll explain why that is. I used to work for the Buffalo Funds here in town, and like all mutual fund companies, they are organized by large cap, mid cap, small cap, growth, value, kind of play in the style box world, and that's just how the investment industry works. Well, imagine if you're a large cap growth mutual fund company and you own Johnson and Johnson, and tomorrow you own Johnson and Johnson and Kenvue. Well, all of your shareholders have hired you to be a large cap growth manager, and now all of a sudden you have this little company called Kenvue. It's not large cap, and it doesn't fit your mandate, and it's not even a growth company, and it's a small cap value. What do you do with it? So you do the same thing a lot of retail investors do when all of a sudden they weren't even paying attention to this. They don't know Kenvue is. They know Tylenol this, but they don't know Kenvue is. So they sell. So for a variety of reasons, these transactions result in a lot of, I call it uneconomic forced selling pressure. So it's a simple law of supply and demand. You get sales. You get all these sales coming through that don't have anything to do with the earnings power of the business, and that drives the price down. That's your opportunity to swoop in and get you a bargain opportunity on the cheap. So if you look at the trading patterns of spin-offs, what you typically see is that all that forced selling pressure will work its way out somewhere between 2 weeks and 2 months. And if you buy right around the 2-month mark, a universe of spin-offs has outpaced the S&P 500 by nearly 14% per year. And now I don't know if it still works. This research is a little bit dated, but it became so widespread that there's an exchange traded fund with the ticker SPIN that just goes out and does exactly that. And I haven't looked at the performance of that in a while, so some of that alpha or return premium might have worn off, but it was legitimate for a long time, and I suspect it still is. So, okay, gang, it's 6:45. I'm gonna let you go. Check out that Claude prompt. I really do want to know what y'all get. Oh, speaking of which, let's see if we got the ADM report. We've been letting that thing run all class. That was over here. Claude reached its tool use limit for this turn. Okay. So I don't know what, that's one of the reasons why I bought the $20 a month plan. So if you're on the freebie plan, you might maybe have to do that once a day or so. So see what kind of luck you have. Give me some feedback, and this may not work for you. I don't know. But if I get that ADM plan completed, I'll send it to you. Yeah. So, all right. Thanks, gang. I appreciate it. We'll see you in a couple weeks. Thanks, Zoom crew.
Here is the difference between O and the free if the data that it's fed is also different.
Oh, that's a good question.
Like change vastly in the report that it's
Yeah.
against.
Yeah, I don't know the answer to that one.
I guess that's a trial and error kind of thing.
Yeah, or it's just as simple as asking. Just to type it in there.
Ask itself about itself.
Yeah.
Yeah.
Thank you for that.
Yeah, I could hear it.
You could see me.
And I could see it. I was like, oh, that's what it is. It's slow.
You could see me twitching. You're like, oh, this guy's gonna go ape shit if he doesn't figure this out.
Great. I feel like the light though, like you did when you were earlier.
Yeah, well, whatever.